There's a common myth about long term investing. You can either chase growth or you can hunt for value. Pick one, you can't have both. Well, I just ran the numbers across the universe of stocks, looking for companies worth holding through 2030 and hopefully beyond. And what I found breaks the rules completely. Four great stocks blending growth plus value. Today, I'm going to walk you through the four best. These four companies range across a variety of industries. What they have in common is the prospects for rapid growth and attractively priced right now, the perfect makeup for a buy and hold portfolio for the next 5 years and beyond. Before I get started, let me introduce myself. I'm Steve Reitmeister, but all my friends call me Righty. I've been in the investing world for over 40 years. Nearly half that time as editor-in-chief of Zacks.com, delivering insights to millions of investors worldwide. And now I'm a partner at WallStreetZen, where I help develop the Zen Rings quant model to help investors like you find great stocks fast. If you're a fan of stock breakdowns like this video, then please do me a quick favor and hit that like button before we get started. All right, lastly, before we get into those four picks, I'm sharing specific stocks with you today, but I'm not giving you personalized investment advice. Always do your own research before buying or selling any stocks. Okay, let's dig in with our first impressive growth and value stock in Jazz Pharmaceuticals with a symbol of JAZZ. This is a big biopharmaceutical company that deals with the development and commercialization of medicines with a primary focus on neuroscience and oncology. Here's what makes Jazz so interesting right now. For years, they were treated as kind of a sleepy specialty pharma name. Reliable, profitable, kind of boring, mostly known for one sleep disorder drug, and now that story is over. Today, Jazz is firing on more cylinders: sleep medicine, epilepsy treatment, and the big one, oncology. The cancer portfolio has grown 45% year over year, and they have a major FDA decision coming this August on a drug with peak sales potential north of $2 billion a year. That single approval could reshape the entire company and make this investment outlook even more bullish. Even with that outcome being uncertain, Wall Street analysts are gushing over the growth potential for the company. The long-term expected earnings growth rate is 35% a year. The most recent earnings report shows that contributions are coming from all three of the main drug groups, most impressive which is oncology, growing 60% quarter over quarter. Yeah, not year over year, quarter over quarter. Not surprisingly, every analyst covering the stocks gives it a buy or strong buy recommendation. In light of the Zen ratings model, it should surprise no one that Jazz carries an elite A grade, which is only given to the top 5% of all stocks analyzed. Now, in this case, the stock is currently the number 3 ranked for its stellar fundamental profile. Not top 3%, number 3, period. The overall Zen ratings composes 7 component grades, so let's take a look at those to see where Jazz really stands out. And remember, the Zen ratings are updated daily, so be sure to check the most up-to-date data for this stock or any other on WallStreetZen.com. It's totally free. Jazz earns an A grade for growth, which is focused on the consistency of growth over time. That's because it's the best predictor of future earnings beats and stocks that outperform. It also earns an A for value, meaning that despite the massive growth, the stock is still very attractively priced. The dual A combination is rare and very appealing. That's because many growth stocks are often too expensive, whereas many value stocks aren't actually growing. Jazz is flexing its muscles on both fronts. The good news doesn't end there, as it also scores in the top 20% of stocks for both momentum and financial strength. That said, let's be direct about what could go wrong here. The biggest near-term risk is obviously that looming August FDA decision. If the drug doesn't get approved, or if there's some other hiccup, the stock will feel it very quickly. Biotech catalysts cut both ways, and Jazz is no exception. While this is a very real risk, both our Zen rating system and the Wall Street consensus suggest that Jazz has the goods to outperform over the long haul and is worthy of your serious consideration. By the way, if you like what you're seeing, then please subscribe to our channel and hit the notification bell so you're first in line to see my next videos. All right, let's keep the party moving with stock number 2 in Seanergy, Maritime Holdings with a symbol of ship. This is the kind of name most retail investors would just scroll on past because it's a small cap shipping company. We are talking about only 330 million market cap here. There's barely any Wall Street coverage on ship, but that's kind of part of the under the radar appeal of this stock, given the attractive upside opportunity as more folks take notice. Now, let's take it from the top. They own and operate a fleet of 17 Cape-size vessels. These are the largest dry bulk carriers in the water, the ships that move iron ore, coal, and raw materials that power the global economy. And the reason this matters so much comes down to supply and demand. Going back a decade, there was a significant drop in new ship orders. This has greatly decreased the size of the fleet relative to the strong demand. As we all know from Economics 101, that leads to serious pricing power for ship and their peers. The containerized freight index has doubled since October 2025, When freight rates go up, companies like Seanergy print money hand over fist. This is a cyclical industry. There's no question about it, but we're catching it at the right part of the cycle with a tailwind that could last for years. The proof of this profit pudding shows up in their 96% expected earnings growth over last year. But what makes Seanergy really stand out is that despite all the growth, the valuation still appears quite cheap. The PEG ratio sits at just over 0.5, meaning you're paying roughly half what you normally pay for this kind of growth. And there's a hearty dividend here too. Seanergy currently yields roughly 5%, given a recent dividend increase. That's about 3 times the yield of the average stock. The appeal of the stock only grows when you consider the Zen ratings breakdown. Now, we're talking about top-notch A grade here, which amounts to a strong buy recommendation. In this case, we're talking about a stock in the top 10 of all 4,600 that we analyze. The component grade breakdown is impressive as well. Seanergy hits an A grade across 4 completely different dimensions. That's a rare suite. We're talking about sentiment, meaning the smart money is already on board. Growth, value. It's rare to see a stock that checks this many boxes simultaneously. Additionally, the industry is very strong according to our Zen industry rank. Never a bad idea to go from one of the best stocks, one of the best industries. And that 5% dividend yield is a nice cherry on top. Our third pick takes us in a completely different corner of the market. We're talking about Nexa Resources with a symbol NEXA. This is a base metals miner with operations across Latin America. They produce zinc, copper, lead, silver, and a little bit of gold. The long-term thesis for this stock comes down to a massive theme that nobody can stop talking about: the energy transition. Think about what's happening in the world right now. Electric vehicles, solar farms, wind turbines, battery storage, and the entire global power grid being upgraded. All of it requires staggering amounts of copper and zinc. Copper for the wiring and electrification itself, zinc for the galvanizing the steel that goes into everything we build to support the infrastructure. The demand is there, but the mining supply takes a decade or more to come online. You can't just snap your fingers and produce more copper. New mines take years to permit, build, and ramp up to full production. That mismatch between supply and demand is the setup for one of the cleanest multi-year commodity bull markets we've seen in a generation. Nexa is positioned right in the middle of all that. They're one of the largest zinc producers in the world with real copper exposure on top. Let's look at the numbers, because this is where Nexa goes from an interesting story to a real exciting opportunity. Recently, Q1 earnings came in 77% above the previous quarter. Here again, not year over year, but quarter over quarter. That's serious earnings acceleration. But the part that really matters for any value investor is this: despite the recent explosion in earnings, the underlying business is still very cheap. Nexa only trades for a forward PE of 5.4. To put that in context, many profitable metals and mining companies typically trade in the 7 to 12 times forward earnings range. This 5.4 is obviously quite attractive. And here's an interesting tidbit. Insiders appear very confident in the company, given that there are no insider sales in the past 12 months. Zero. Okay. Please note that the shares have come up considerably over the past year, so insiders not cashing in no doubt means they see ample upside ahead. Nexa is another big winner in light of the Zen Ratings review. They get an A grade overall, pointing to a strong buy recommendation. This is based on being the top 1% of all stocks reviewed for their fundamental profile. History shows that typically leads to future outperformance. As we drill down the component grades, it delivers 3 A grades worth mentioning: value in the top 2% of all stocks, growth in the top 1%, and momentum in the top 1% as well. Too often, value stocks aren't timely. That problem is rectified with their stellar momentum grade. Now, let's be real about the risk. Commodity price risk is the headline. Zinc and copper prices are set globally, and they move with macro sentiment. Any global slowdown can hit base metal prices hard and fast, and that would obviously sour the outlook for Nexa. That said, Nexa presents a great opportunity to take advantage of the current supply shortage for key materials that could drive meaningful gains for years to come. This likely explains why zero insiders are selling shares at this time. Plus, you have a compelling value proposition that lights a path to buying shares now for potential serious long-term gains. Before I get to that last stock, I want to invite you to join me for a live training session this coming Monday at 7 p.m. Eastern Time. That's when I share my updated market outlook, my trading plan to beat the market, as well as the top 7 stocks for the week ahead. In these live training sessions, you'll get the best of the Zen Ratings in my greater than 40 years of investing experience. So be sure to join me this coming Monday at 7 p.m. Eastern. It's totally free. Just sign up at WallStreetZen.com/live. You'll also find a link in the description, or scan the QR code on the screen. Look forward to seeing you there on Monday. Let's wrap things up with the fourth and final buy and hold stock. We're talking about Bioventus with with the symbol BVS. I truly saved the best for last here. That's because this is the number one ranked stock in the ZenRings database of over 4,600 companies analyzed. Bioventus is a medical device company focused on helping the human body heal itself. Now, they specialize in orthopedics and pain management, restorative therapies with products that treat osteoarthritis, support bone healing after surgery, and address chronic musculoskeletal pain without the need for opioids or invasive procedures. Now, before you yawn just a bit too loud, let me spell out the growth story for you that makes this a compelling stock pick for a long-term portfolio. We're talking about the aging of the population. This is one of the most powerful demographic tailwinds in modern history. By 2030, the number of Americans over 65 will surge to roughly 73 million people. And this is also happening worldwide. That's tens of millions of joints that need treating, and tens of millions of bones that need healing, and a healthcare system that desperately needs alternatives to opioids and invasive surgery. BVS sits right at the very center of that dynamic wave of demand, the benefit of which is starting to show up meaningfully in their earnings reports, like how earnings per share soared 88% higher year over year. Wall Street analysts expect the growth part to continue for the next several years at an average annual pace just under 20% per year. Now, surprisingly, all current covering Wall Street analysts have buy ratings on these shares. Even better, the Street High Fair Value forecast calls for roughly 80% upside in just the next year alone. As already shared, Bioventus is currently wearing the Zen Ratings crown as the number one ranked stock overall. Calling it just an A rating seemed unfair, so let's go for A+++. Now let's drill down to the component grades and see what else that tells it. Now, value, of course, is going to be strong here. We have an A-rated stock in the top 3% of all stocks tracked. Now, combine that with a glorious growth grade, A, also in the top 1% of our model, and you are starting to get the excitement here. Financials and safety are also solid with B grades. That puts in the top 20% of all stock we review. This confirms that beneath the aggressive upside potential lies a fundamentally sound balance sheet in a highly stable operation. And to round things out, we have a sentiment score also in the top 1%. This indicates powerful interest from the smart money crowd. Typically a good idea to follow their lead. One noteworthy risk with BVS is that reimbursement risk is real in their business. If CMS or private payers reduce coverage or reimbursement rates for any of the company's key products, it can compress margins quite quickly. This is a recurring headwind in the medical device space, and BVS is not immune to that. All that said, we have a compelling macro setup with the aging of the population, and Bioventus is executing brilliantly, given that it's the number one ranked stock after the full 115 fundamental factor review of the Zen Ratings model. And yes, our top ranked stocks do have a strong track record of outperformance, so do consider if Bioventus has a spot in your long-term portfolio. There you have it. 4 promising buy and hold opportunities available right now. Not just flexing impressive growth potential, but also very attractively priced at this time. Now, do you think any of these 4 stocks will earn a place in your portfolio? Please share your thoughts in the comment section below for the benefit of our community. Plus, I read every comment. And if you want more stocks with long-term appeal, then please check out my video featuring 6 high-growth stocks to buy and hold forever.